हेलो एवरीवन, मैं मनविंदर और मेरी कलीग अंशिका आज की वीडियो में आपको यह समझाएंगे कि ऑप्शंस क्या होते हैं और उनको ट्रेड कैसे किया जाए यूजिंग ऑप्शन स्ट्रैटेजीज। आजकल स्टॉक मार्केट्स काफ़ी बुल रन में है और हमने देखा है कि रिटेल पार्टिसिपेशन काफ़ी ज़्यादा बढ़ गई है। बट अक्सर ये होता है कि उन रिटेल पार्टिसिपेंट्स को अप्रोप्रिएट नॉलेज नहीं होती कि डेरिवेटिव मार्केट में डील कैसे करें। तो आज की हमारी वीडियो उसी इशू को टैकल करेगी कि व्हाट आर डेरिवेटिव्स एक्चुअली, और स्पेसिफिकली इस वीडियो में हम ऑप्शंस के बारे में बात करेंगे ताकि आप उन्हें समझ पाए और ऑप्शन स्ट्रैटेजीज को कैसे आप प्रैक्टिकल रियल लाइफ इंडियन स्टॉक मार्केट्स में अप्लाई कर पाए। तो चलिए शुरू करते हैं। First and foremost, what are derivatives? Derivative is an instrument which derives its value from an underlying asset. This underlying asset can be a commodity, a currency, a bond, a stock, or a stock index. डेरिवेटिव के चार मोस्ट कॉमन एग्जांपल्स हैं फॉरवर्ड्स, फ्यूचर्स, ऑप्शंस और स्वैप्स। इस वीडियो में हम स्पेसिफिक फोकस देंगे ऑप्शंस पे। So what are options? Options are contracts which give the contract holder the right but not the obligation to buy or sell the underlying assets. Call and put option. ऑप्शन दो तरीके के होते हैं। पहला कॉल ऑप्शन। कॉल ऑप्शन is a right to buy an underlying asset at a specified price or on a particular day by paying a premium. Similarly, a put option is a right to sell the underlying asset at a specified price on or before a particular day by paying a premium.
Hello everyone. In order to better understand what a call option is, we now have an example to explain it further. Now, let us say we have an investor and he buys a call option in order to purchase 100 Reliance shares at a price of rupees 300 on 15th October 2002. The current price is 250 rupees and the premium for the option is 25 rupees per share. Therefore, the investor will have to pay rupees 2500 as a premium for buying the call option, and this is also known as the initial investment. He is entitled to get 100 shares of Reliance at a price of rupees 300 on 15th October 2002. Now let us suppose that the market price of Reliance goes up to rupees 400. अब जो हमारा इन्वेस्टर है, he will exercise his right by paying rupees 30,000, that is the original contract price. Now he can sell these shares in the market at the current price of rupees 400 and get 40,000 rupees. Now the net gain to the investor in this transaction is rupees 7,500, that is the spot price, which is 40,000, minus the strike price, which is 30,000, minus premium, which is 2,500. Now let us suppose that the price of Reliance shares goes down to 200 rupees by 15th October 2002. Now the investor will not exercise his option as he is under no obligation to buy the shares. His loss will only be rupees 2,500, that is the premium he had paid to purchase the call option. Therefore, a call option has unlimited profit potential as there is no upper limit to the stock price. Similarly, we'll be explaining put option with the help of an example. Now let us say हमारे पास एक investor है and he buys a put option in order to sell Reliance shares at a price of rupees 300 by October 15th, 2002. He pays a premium of rupees 25 per share to buy this option. Now, if the share price of Reliance goes down to say 200 rupees, the investor can exercise his right to sell these 100 shares at a strike price of rupees 300. He will buy 100 shares at rupees 200 per share to sell them at rupees 300 per share. All in all, his net gain is 7500, that is the strike price, which is 30,000, minus the spot price, that is 20,000, minus premium, that is 2500. Now suppose the share price of Reliance goes up to rupees 350 rupees. The investor will not exercise his option and his loss will be rupees 2500, which he had paid as premium. It is worthwhile exercising a put option only if the market price of the stock turns out to be lower than the strike price. If the strike price is greater than the stock price, the option has an intrinsic value. The buyer of an option pays a premium which consists of the intrinsic value, if any, plus time value. The maximum profit from buying a put option is limited only by the fact that the stock price cannot fall below zero. Now, there are two other important types of options. One is the European style options and the other is the American style options. European style options can be exercised only on the maturity date of the option, which is known as the expiry date. American style options can be exercised at any time before and on the expiry date. अब हम डिस्कस करेंगे इन द मनी, आउट ऑफ द मनी एंड एट द मनी ऑप्शंस. नाउ इन ऑप्शंस ट्रेडिंग जो मेन पॉइंट ऑफ डिफरेंस है बिटवीन इन द मनी एंड आउट ऑफ द मनी, दैट इज़ अ मैटर ऑफ द स्ट्राइक प्राइसेस पोजिशन relative to the market value of the underlying stock, and इसे हम उसकी moneyness भी कहते हैं. And in the money option is one with a strike price that has already been surpassed by the current stock price. And out of the money option is one that has a strike price which the underlying security has yet to reach, meaning उस option की intrinsic value 0 है. एंड फाइनली जब स्ट्राइक प्राइस इक्वल होता है स्पॉट प्राइस के लिए, इसे कहते हैं एट द मनी ऑप्शन.
लेट्स टॉक अबाउट ऑप्शन ट्रेडिंग स्ट्रैटेजीज. हमने इस सेक्शन को 3 पार्ट्स में डिवाइड करा है, विच आर ऑप्शन स्प्रेड्स, सेकंड इज वॉलेटिलिटी ट्रेडिंग एंड थर्ड इज आर्बिट्राज विद ऑप्शंस. तो सबसे पहले बात करते हैं ऑप्शन स्प्रेड्स की. Vertical spreads. Vertical spread involve simultaneous buying and selling of the options of the same underlying asset and for the same expiration date, but with different exercise prices. Bull spread. Bull spread ऐसे डिजाइन होता है कि it is created by buying at a low strike price option and selling at a high strike price option. It is designed in सच अ वे कि प्रॉफिट्स तब होंगे कि जब मार्केट ऊपर जाएगी या फिर स्टॉक ऊपर जाएगा. जब एक इन्वेस्टर को लगता है कि हाँ आज मार्केट ऊपर जाएगी, तो वो एक बुल स्प्रेड क्रिएट करता है, और बुल स्प्रेड कैन बी क्रिएटेड विद ईदर कॉल ऑप्शंस और पुट ऑप्शंस. तो आइए डिस्कस करते हैं बुल स्प्रेड यूजिंग कॉल्स ऑन एन इंडेक्स. तो एक इन्वेस्टर बुल स्प्रेड में कॉल ऑप्शन खरीदता है विच इज बिलो द करंट इंडेक्स प्राइस, और एट द सेम टाइम वो कॉल ऑप्शन बेचता भी है विच इज अबव द इंडेक्स करंट प्राइस. इस स्ट्रैटेजी से उसका प्रॉफिट पोटेंशियल और रिस्क पोटेंशियल दोनों लिमिट हो जाते हैं. इस स्ट्रैटेजी का पे ऑफ इज द डिफरेंस between the amount of the strike price of the option which is bought and the option which is sold.
Suppose an investor buys one market lot of Feb 1100 Nifty calls at Rs 96 a call and sells one market lot of Feb 1200 Nifty calls for 60 rupees a call. If Nifty closes between 1100 and 1200, the payoff is the amount by which the index exceeds 1100. In this case, suppose the index closes at 1160 on the expiry date. Then the payoff is 60 rupees. The cost of setting up this spread is rupees 36, which is 96 minus 60. It's the difference between the call premium paid and received. The net profit from the position is rupees 24, which is 60 minus 36.
Similarly, let's discuss a bull strategy using put option. In case of put options, the bull spread consists of buying a put with a lower exercise price and selling a put with a higher exercise price. It produces a net initial credit as the high strike price option is more expensive than the low strike price option. The maximum profit is equal to the net option premium income or net credit. The maximum loss is equal to the higher strike price less the lower strike price less the net premium received. Break-even price is equal to the higher strike price less the net option premium income. The margins on call-based bull spreads will be far lower than that of on put-based bull spreads. The possibility of losses in call-based spreads is negligible as the differential premium is paid upfront. चलिए अब डिस्कस करते हैं बेयर स्प्रेड। एक इन्वेस्टर बेयर स्प्रेड में तब आएगा जब वो होप कर रहा है कि फ्यूचर में प्राइसेस गिरेंगे। तो इसीलिए ये स्ट्रेटजी ऐसे डिजाइन हुई है कि इट विल प्रॉफिट व्हेन द प्राइसेस गो डाउन। Bearish vertical spreads are created by buying at a high strike price option and selling at a low strike price option. यहाँ भी bearish spread हम call और put option दोनों तरीकों से बना सकते हैं। Bear spread with calls. So bear vertical spread with calls are created when we sell a call with low strike price and at the same time we purchase a call with a high strike price. It produces a net credit strategy since a low strike price is there. The maximum profit here is equal to the net premium received and the maximum loss is equal to the higher strike price option less the lower strike price option less the net premium received. The break-even here is equal to the lower strike price plus the net premium received. Hence, the bear spread with call option is not only limits the trader's risk, but also it limits their profit potential.
Suppose an investor buys one market lot of February 1500 Nifty calls at 60 rupees a call and sells one market lot of Feb 1400 Nifty calls for 96 rupees a call. If Nifty closes at 1420 on the expiry date, his profits get reduced to the extent it falls short of the lower strike. In this case, the index falls short of the lower strike by 20 rupees. Hence, his payoff is 96 minus 60 minus 20, which is 16 rupees.
Bear spread using puts. In case of a bearish option spread with puts, एक इन्वेस्टर बाय करता है पुट एट अ हायर स्ट्राइक प्राइस और सेल करता है पुट को एट अ लो स्ट्राइक प्राइस। ये एक नेट डेबिट स्ट्रैटेजी है एज हाई स्ट्राइक प्राइस ऑप्शन लो स्ट्राइक प्राइस ऑप्शन से ज़्यादा एक्सपेंसिव है। द मैक्सिमम प्रॉफिट हेयर इक्वल होता है हायर स्ट्राइक प्राइस ऑप्शन लेस द लोअर स्ट्राइक प्राइस ऑप्शन लेस द नेट प्रीमियम पेड। The maximum loss here is equal to the net premium paid. Here, break-even price is also equal to the higher strike price less the net premium paid. Thus, the upside potential and downside risk is limited. ऑप्शन स्प्रेड्स में और भी अलग अलग कैटेगरी की स्ट्रैटेजीज होती हैं। फॉर एग्जांपल हॉरिजॉन्टल और कैलेंडर स्प्रेड। यहाँ पे ऑप्शन यूज होते हैं जिनके स्ट्राइक प्राइस सेम होते हैं लेकिन एक्सपायरी डेट अलग होती है। और एक और स्ट्रैटेजी होती है डायगोनल स्प्रेड की जो वर्टिकल और हॉरिजॉन्टल दोनों के फीचर कंबाइन कर देते हैं। दैट इज डिफरेंट एक्सपायरी एंड डिफरेंट स्ट्राइक प्राइस एज वेल।
So now I'll be talking about our second option trading strategy, that is volatility trading. Volatility trading is taking positions on changes in the market expectations of price volatility. The main strategies for trading volatility are straddles, strangles, and butterflies. Now, straddles and strangles are examples of combinations which are option trading strategies that involve taking a position in both calls and puts on the very same stock. We will now be discussing straddle, which comes under volatility trading. Now, straddle is a position of buying a put and a call जिसका same price and expiration date होता है. Straddle is an expensive strategy क्योंकि the trader he has to pay 2 premiums. But a price swing in either direction compensates for this higher cost. Now the investor believes that the price of the underlying asset will either rise or fall significantly. However, he or she does not know the direction of this price movement. Major pronouncements such as divestment, budget time, acquisitions, lawsuits, etc. to be decided on a particular day are good times to purchase straddles. A long straddle is buying one put and one call option simultaneously on the same stock at the same strike price with the same maturity, whereas on the other hand, a short straddle is a simultaneous sale of 2 such options at the same strike price and expiration date. The long straddle is also referred to as bottom straddle and short straddle as a top straddle. The purchaser of a long straddle takes the view that volatility will be high in the future, whereas the seller of a straddle takes the view that the volatility would be low. The profit potential on a long straddle is unlimited on the upside and limited on the downside, while profit potential on a short straddle is limited to the recipient of the premium, which occurs if the price at the expiration is the same as the strike price of the options. Now, the maximum loss on a long straddle is the loss of premium paid, and it occurs if the price at the expiration is the same as the strike price of the options, while loss on a short straddle is unlimited on the upside and limited on the downside. A short straddle is a highly risky strategy. We will now be explaining how straddle works with the help of an example. Now let us suppose हमारे पास एक investor है and he feels that the stock price is likely to move significantly जो next 3 महीने हैं. Now the stock is currently trading at rupees 690. A 3-month call with a strike price of rupees 700 will cost him 40 rupees, whereas a 3-month put with the same strike price will cost him 30 rupees. Now let us say जो trader है हमारा, he buys both the put and the call. Now, if the stock price is rupees 700 in 3 months, the strategy cost our trader rupees 70, that is 40 plus 30. In this situation, the buyer will profit from his strategy only if the stock price moves further away from our 700 rupees. Now suppose the stock price is rupees 900. Then the strategy leads to a profit of 130 rupees, that is 900 minus 700 minus 70 rupees. If the stock price moves down to rupees 550, the strategy leads to an overall profit of rupees 80 rupees. अब हम डिस्कस करेंगे स्ट्रैंगल, जो हमारा सेकंड सब टॉपिक है वॉलेटिलिटी ट्रेडिंग के अंडर. Now, like straddle, a strangle is the buying or selling of a combination of one call option and one put option with the same maturity. But unlike straddle, strangle has different exercise prices. Now in a strangle, the call has an exercise price above the stock price and the put has an exercise price below the stock price. A long strangle is buying one put and one call option at different strike prices as the trader expects a significant movement in the prices. A long strangle is an aggressive form of straddle position. The profit potential is unlimited on the upside and limited on the downside, while the maximum loss is the loss of premium paid. A short strangle, on the other hand, is selling one call and one put option at different strike prices. Now, the seller expects that the market prices will move marginally or be less volatile. This is a conservative form of straddle position. The profit potential is limited to the receipt of the premium, and the loss is unlimited on the upside and limited on the downside, as shown in the diagram. We will now be discussing the third strategy under volatility trading, that is butterfly spread. Now, butterfly spread is a combination of a bull and a bear spread. This strategy is used when the investors expect that the stock prices will not significantly rise or decline by the expiration. Now, this position is created by buying two call options, one with a relatively low strike price, let us call it X1, and the other with a relatively high strike price, let us call it X3, and selling two call options with a strike price of say X2, that is halfway between X1 and X3. We will now further understand what a butterfly spread is with the help of an example. Now, in a butterfly spread, risks and profits are limited. The maximum profit is realized if the stock price at the expiration is close to X2, as shown in the given figure. Now, let us suppose a stock is selling for ₹91. The prices of call options expiring in 6 months are quoted as follows. There is ₹85 against ₹10 call price, ₹90 strike price against ₹7 call price, and ₹95 strike price against ₹5 call price. Now, in this case, the investor can create a butterfly spread by buying one call with a ₹85 strike price, that is X1, buying another call with a ₹95 strike price, that is X3, and selling two calls with ₹90 strike price, that is X2. This costs the investor ₹1. Now, the net loss would be equal to ₹1 if the stock price moves outside the range of ₹86 to ₹94, but would lead to a maximum profit of ₹4 if the stock price is ₹90 at the expiration date. Now, if the stock price is ₹90, the long call with an exercise price of ₹95 loses its full purchase price of ₹5. The long call with an exercise price of ₹85 loses ₹5, that is ₹5 stock profit minus ₹10 purchase price. Together, the long calls lose ₹10. The short call gives a profit of ₹7 per option for a profit of ₹14 on the two options. Now, this gives a net profit of ₹4 if the stock price is ₹90. By using put options, the investor buys two puts, one with a low strike price and another with a high strike price, and sells two puts with an intermediate strike price. A limitation of this strategy is that it may be a bit too difficult to execute quickly. Also, a butterfly spread can be created with the help of only put or a combination of one call and one put. We will now be discussing the comparison of the volatility trading strategies which we've recently discussed. Straddles involves the highest potential profits, but also the greatest potential losses. In the case of strangles, there is a low maximum loss, but likelihood of occurrence of losses is extremely higher. Butterflies involve small potential losses, but at the cost of limited profit possibilities. A butterfly spread resembles a short position in the straddle. Compared to a straddle, the risk of a large loss is reduced by the butterfly spread. Now, a general rule underlying all volatility trading strategies are that higher potential profits are obtained at the cost of a higher risk.
तो यहाँ हमने पढ़ी सेकंड स्ट्रैटेजी ऑफ वोलेटिलिटी ट्रेडिंग। अब चलते हैं हम अपनी थर्ड स्ट्रैटेजी पे, which is arbitrage with options. So arbitrage is basically a process of making riskless profits using mispricing. बेसिकली यहाँ पे आर्बिट्राजर एक सिक्योरिटी को परचेज करता है और साइमल्टेनियसली एट द सेम टाइम एक दूसरी मार्केट को उसी सिक्योरिटी को एक हायर प्राइस पे बेच देता है। पुट कॉल पैरिटी ये एक कॉन्सेप्ट है जो एक्सप्लेन करता है कि पुट और कॉल प्राइसेस रिलेटेड होते हैं बाय अ कंडीशन और इक्वेशन। Put call parity is nothing more than the observation that buying a put is equivalent to selling the underlying and buying a call. It is expressed as
Spot price of the underlying plus price of the European put option is equal to price of the European call option plus exercise price of options divided by 1 plus risk-free rate of interest to the power time to expiry.
अब हम डिस्कस करेंगे आर्बिट्राज बियॉन्ड अपर एंड लोअर बाउंड्स. Now there are 6 factors affecting the value of an option before expiration. These are the price of the underlying stock, the exercise price of the option, the time remaining until expiration, the risk-free rate of interest, the volatility of the underlying asset, and finally the dividends expected during the life of the option. Now these factors set the general boundaries for options pricing. If the option price is above the upper bound or below the lower bound, there are profitable opportunities for arbitrageurs. We will now be discussing upper bounds. Now, a call option gives the holder the right to buy a stock or an index for a certain price. As the option can never be worth more than the stock or the index, the stock price is an upper bound to the option price. C is less than S, where C refers to the price of the call option and S refers to the current stock price or the current index level. Now, if the given relationship does not hold true, then an arbitrager can easily make a riskless profit by buying the stock and selling the call option. A put option gives the holder the right to sell a stock or index for, let's say, a price X. Now, no matter how low the stock price or index level becomes, the option can never be worth more than X. Hence, P is less than or equal to X. Now, if the above relationship does not hold true, the arbitrager would make a profit by writing puts. We will now be discussing lower bounds. Now, the lower bound for the price of a call option is shown by equation 1. If the price of a call is not worth at least even this much, then it will be possible to make riskless profits. If the call is available at a premium which is less than the lower bound, that is, if equation 1 is less than C, then the arbitrager can buy the call and short the stock or index and earn riskless profits. The lower bound for the price of a put option is equation 2. The price of a put must be worth at least this. Otherwise, it will be possible to make riskless profits. If the price of a put is not worth at least this, then it will be possible to make a riskless profit. If the put is available at a premium which is less than the lower bound, that is, equation 2 is less than P, then the arbitrager can buy both the put and the stock or index by borrowing money and earning riskless profits.
So that would be the end of our video. Thank you so much everyone यहाँ तक देखने के लिए, और अगर आपका कोई क्वेश्चन या फिर डाउट है तो आप उसे कमेंट कर दीजिए और मैं और अंशिका उसे ज़रूर आंसर करेंगे। थैंक यू सो मच।